Listen carefully. What you are seeing in silver right now is not as straightforward as it looks. I know the move feels strong. I know it looks convincing. But I am telling you directly, this is exactly the kind of moment where most investors misread the signal and pay for it later. You are being shown momentum, but you need to ask yourself what is driving that momentum, because in a stable system, price appreciation often reflects growth, confidence, and expansion. But we are not in a stable system. We are in a system saturated with debt, dependent on liquidity, and increasingly sensitive to pressure that most people cannot see. So when silver starts moving aggressively in this kind of environment, I am not thinking about upside first. I am thinking about stress. You need to understand that distinction. Most people don't. They see a rising asset and assume strength. They assume confirmation. They assume the market is validating a bullish narrative. But that is not how late cycle systems behave. Late cycle systems distort signals. They make risk look like opportunity. They make pressure look like momentum. And if you follow that misinterpretation, you end up positioned on the wrong side of a structural shift. This is not speculation. This is how financial systems behave under strain. I want you to think beyond the price itself. Silver is not moving in isolation. It never does. It sits inside a much larger machine, a machine driven by credit, liquidity, leverage, and confidence. When one of those elements begins to weaken, the effects ripple outward. They do not stay contained. Right now, that machine is under pressure. Debt levels remain elevated across the system. Your refinancing is becoming more expensive. Liquidity is no longer as abundant or as predictable as it was during the expansion phase. And most importantly, the assumption that central banks can stabilize everything is starting to weaken. That matters more than anything else, because modern markets are built on belief. Belief that liquidity will be there, belief that volatility will be managed, belief that leverage is safe because it can always be rolled forward. History has proven this again and again. That belief looks strongest right before it is tested. And when it is tested, the shift is not gradual. It is abrupt. Now I want you to focus on something critical. The real question is not whether silver can go higher. It can. That is not the point. The real question is why it is moving the way it is moving right now under these exact conditions. Because when capital starts rotating into monetary assets during a period of tightening conditions, it is not always about optimism. Sometimes it is about protection. Sometimes it is about doubt. Sometimes it is about institutions quietly adjusting before the broader market understands what is happening. This is where most investors fall behind. They react to the visible move. They do not investigate the invisible cause. And that is where the risk begins. You have to understand leverage to understand what comes next. Leverage amplifies everything. In good times, it makes returns look smooth and predictable. It reinforces confidence. It convinces participants that the system is stable. But that stability is conditional. Once conditions begin to tighten, leverage stops being supportive and starts becoming restrictive. It limits flexibility. It forces decisions. It turns optional actions into mandatory ones. And this is where margin pressure enters the picture. I am not talking about a minor correction. I am talking about a shift in behavior. A margin call is not just a technical event. It is a demand for liquidity. It is the system forcing participants to act whether they want to or not. It is the moment when selling is no longer strategic, it becomes necessary. And when that begins, it does not stay isolated. It spreads. Positions that seem secure suddenly become vulnerable. Assets that were assumed to be liquid become harder to exit. Correlations begin to rise. Your diversification starts to fail. This never ends quietly. Now place silver inside this framework. Silver is not just another asset. It carries monetary significance. It reacts to inflation expectations, to currency instability, to shifts in confidence, and to capital seeking protection from systemic risk. So when you see a strong move in silver during a period where liquidity is tightening and leverage remains high, you have to ask a deeper question. Is this a move toward opportunity? Or is this a move away from risk? Because those are two very different signals. And if you confuse them, you position yourself incorrectly for what comes next. Most people are completely blind to this distinction. They are focused on the chart. They are focused on recent performance. They are focused on what has already happened instead of what is beginning to form. But the market does not reward backward thinking. It rewards those who can interpret structure. And the structure right now is telling you something important. Credit conditions are tightening. Liquidity is becoming selective. Confidence is no longer uniform. And when those elements start to shift at the same time, behavior changes, not slowly, suddenly. You need to be prepared for that, because once the system transitions from voluntary behavior to forced behavior, time compresses. What looks stable can break quickly. What feels manageable can become uncontrollable. And by the time it becomes obvious, it is already too late to reposition without cost. That is why this moment matters. Not because silver is rising, but because of what that rise may be signaling beneath the surface. And if you are not asking the right questions right now, you are already behind the shift that is beginning to unfold. Now I want you to go one layer deeper, because this is where the real implications begin to take shape. Most investors believe instability arrives with noise. They expect headlines, panic, and visible breakdowns. But that is not how systemic pressure actually develops. It begins quietly, almost invisibly, through small changes in conditions that the majority assumes will remain stable. Funding costs start to rise, not dramatically at first, but enough to matter for those operating with leverage. Refinancing windows become narrower. Terms become less forgiving. Lenders begin to reassess risk, not publicly, but internally. And that is where the shift starts, because the modern financial system is not built on unleveraged strength. It is built on assumptions about liquidity, about access to capital, about the ability to roll debt forward without disruption. When those assumptions begin to weaken, even slightly, the entire structure becomes more fragile. You need to understand that fragility does not announce itself. It accumulates. Positions that were comfortable under loose conditions become tight under restrictive ones. Risk models that worked in a liquidity-rich environment begin to fail when liquidity becomes selective. And because so many participants are positioned based on similar assumptions, the adjustment does not happen in isolation. It happens collectively. This is where margin pressure becomes systemic. At first, it looks manageable. A few positions are reduced, some assets reprice. Volatility increases slightly. But beneath that surface, something more important is happening. Behavior is changing. Investors stop asking what they want to own. They start asking what they can afford to hold. That is a completely different mindset. And once that shift occurs, the market is no longer driven by conviction. It is driven by constraint. This is the environment where margin calls begin to matter, because a margin call forces action. It does not care about your long-term thesis. It does not care about your conviction. It only cares about whether you can meet the requirement for collateral in that moment. If you cannot, you sell. And when enough participants are forced into that position at the same time, selling becomes contagious. This is how liquidity events unfold. Now think about what that means in the current environment. We are coming out of a prolonged period where liquidity was abundant and widely accessible. Central banks supported markets aggressively. Interest rates remained low. Risk-taking was rewarded. Leverage became normalized. That environment shaped behavior. It conditioned investors to expect stability. It encouraged them to extend risk. It reinforced the belief that any disruption would be contained. But that environment is changing. Liquidity is no longer unlimited. Policy flexibility is more constrained. Inflation pressures have forced central banks into more difficult positions. And as a result, the margin for error across the system has narrowed. This is not theoretical. This is structural. And when you combine that with elevated debt levels and widespread leverage, you create conditions where even a modest shift can trigger a larger reaction. This is why Dalio's warning about margin call risk is not something you dismiss. It is something you study. Because he is not reacting to noise. He is recognizing a pattern that has repeated throughout history. Late in the debt cycle, pressure builds beneath the surface. Confidence remains outwardly intact. Markets continue to function. But the underlying conditions become increasingly unstable. Then something changes. It does not have to be dramatic. It only needs to be enough to challenge the assumptions that the system relies on. Once that happens, the adjustment begins, and it accelerates. Now bring silver back into the picture. If capital is moving into silver at the same time these conditions are forming, you need to consider what that movement represents. It may not be about chasing returns. It may be about reducing exposure to systemic risk. It may be about anticipating instability before it becomes obvious. That is how experienced capital behaves. It does not wait for confirmation. It positions ahead of it. Meanwhile, the majority does the opposite. They wait for clarity. They wait for validation. They wait until the narrative becomes widely accepted. But by the time that happens, the opportunity to act with control is already gone. This is the difference between preparation and reaction. Preparation happens under uncertainty. Reaction happens under pressure. And in a margin-driven environment, reaction is expensive. You also need to understand how quickly conditions can change once forced behavior begins. Time compresses. Moves that would normally unfold over months can happen in days. Liquidity that seemed reliable becomes selective almost overnight. This is not an exaggeration. This is how these systems operate, because once selling becomes forced, it feeds on itself. Lower prices create more pressure. More pressure leads to more selling. And the cycle reinforces itself until something stabilizes it. That stabilization can come from policy intervention. It can come from a reset in positioning, or it can come from the exhaustion of sellers. But until that happens, the system remains under stress. This is why early signals matter. Not because they give you a precise timeline, but because they tell you what kind of environment you are entering. And right now, the signals are telling you that conditions are tightening, that leverage is becoming more fragile, and that liquidity is becoming more important. You cannot ignore that, because if you do, you are relying on a version of the market that may no longer exist. And that is where the real risk lies, not in volatility itself, but in misreading the environment that produces that volatility. You need to stay focused on structure, because structure determines outcomes, and the structure right now is shifting in a way that demands attention. Now I want you to step back and look at the system as a whole, because this is where clarity becomes unavoidable. You are not dealing with isolated signals. You are dealing with a network of dependencies that have been building for years. Credit expansion, asset inflation, policy intervention, and leverage have all reinforced each other for a long time. That reinforcement created stability on the surface, but underneath it created dependence. Dependence on low rates, dependence on continuous liquidity, dependence on confidence remaining intact. And when a system becomes dependent, it also becomes vulnerable. This is the part most people fail to recognize. They think strength is permanent because it has lasted. They assume resilience because disruption has been managed in the past. But resilience that depends on support is not true resilience. It is conditional. And conditions are changing. You can already see it in multiple areas at once. Liquidity is no longer as predictable. Policy credibility is no longer unquestioned. Debt levels are not declining, they are becoming more difficult to sustain. These are not small adjustments. These are foundational pressures. When those pressures reach a certain point, the system does not adjust smoothly, it reacts. And those reactions are driven by constraint, not preference. That is when margin pressure becomes unavoidable, because the entire structure is built on collateral values, and collateral values are supported by asset prices. If asset prices begin to lose stability, even temporarily, the confidence that supports leverage begins to weaken. Once that happens, The system starts to pull liquidity inward. Lenders become more cautious. Borrowers become more defensive. Capital becomes selective. And that selectivity is what creates imbalance. Some assets receive support, others lose it. Some positions remain stable, others are forced to unwind. That is how fragmentation begins. And once fragmentation begins, correlations start to change. Assets that were supposed to offset each other begin to move together. Diversification stops working the way investors expect it to. This is where the majority gets caught off guard, because they are positioned for a continuation of normal conditions. But this is not a normal phase. This is a transition, and transitions are where mistakes become costly. Now, I want you to think about how silver fits into this broader shift. Silver is not simply reacting to inflation or industrial demand. It is responding to changes in trust in currency stability, trust in financial assets, trust in policy effectiveness. When that trust begins to weaken, capital starts looking for alternatives, not all at once, not in a straight line, but progressively. And that progression often begins before the narrative becomes clear. That is why silver can move ahead of broader recognition. It becomes a reflection of early positioning, not confirmation, positioning. And that distinction matters, because positioning happens quietly. It happens before the headlines, before the consensus, before the majority understands the reasoning behind it. By the time the narrative catches up, the move is already well underway. This is where smart capital separates itself. It does not need certainty. It needs probability. It looks at the structure. It evaluates the conditions. It recognizes when the balance between stability and fragility begins to shift, and then it acts accordingly. The majority does not operate that way. The majority waits for clarity. It waits for reassurance. It waits for confirmation that the move is justified. But in doing so, it sacrifices timing, and timing is critical in environments where behavior can become forced. Because once forced behavior begins, you are no longer making decisions freely. You are reacting to constraints. This is what you need to avoid. You need to maintain control over your positioning before the system removes that control. And that requires a shift in mindset. You cannot think in terms of simple narratives anymore. Bullish or bearish is not enough. Up or down is not enough. You have to think in terms of structure. What is happening to liquidity? What is happening to leverage? What is happening to confidence? Because those are the variables that determine how markets behave under stress. If liquidity tightens, flexibility disappears. If leverage becomes unstable, volatility increases. If confidence breaks, behavior changes rapidly. And when those three elements align, the system moves quickly. That is when margin pressure becomes the dominant force. Not earnings, not growth, not sentiment, liquidity. And when liquidity becomes the central issue, everything else adjusts around it. This is why Dalio's signal matters. It is not about predicting a crash tomorrow. It is about recognizing that the conditions for a forced adjustment are forming. And once those conditions reach a threshold, the transition will not wait for consensus. It will happen. The real question is not whether you can predict the exact timing. The real question is whether you are positioned to handle it. Because if your portfolio depends on stable liquidity, you are exposed. If your assumptions depend on correlations holding, you are exposed. If your confidence is based on recent performance, you are exposed. These are not comfortable realizations, but they are necessary. Because preparation is not about fear. It is about control. Control over your positioning, control over your risk, control over your ability to respond when conditions change. Cash, in this context, is not a passive asset. It is optionality. It gives you the ability to act when others are forced. Hard assets, including silver, play a role. But only if you understand why they are moving, not just that they are moving. Because if you misinterpret the signal, you can still be positioned incorrectly even in the right asset. This is why clarity matters. You need to interpret the message behind the move. And the message right now is not simple. It is telling you that the system is under pressure. It is telling you that capital is beginning to adjust. It is telling you that conditions are becoming less stable than they appear, and if you ignore that, you are choosing to operate with incomplete information. That is not a strategy. That is exposure. History shows this pattern clearly. Late-stage cycles always feel manageable until they are not. Confidence remains intact until it breaks. Liquidity feels sufficient until it becomes scarce. And when that shift happens, the adjustment is not gradual. It is decisive. This never ends quietly, so you have a decision to make. You can follow the surface level narrative and assume that price strength reflects safety. Or you can step back, analyze the structure, and recognize that strength can sometimes signal stress. That is the difference between reacting and understanding. And in this phase of the cycle, that difference determines whether you navigate the transition with discipline or get caught inside it. Silver is not just moving, it is signaling. It is forcing you to ask whether the system is as stable as it appears. And how you answer that question will define your position in what comes next.